To buy a call debit spread on Robinhood, start by understanding the basics of options trading in the platform. A call debit spread is a strategy involving two call options with different strike prices, where you buy one call and sell another with a higher strike price. First, open the Robinhood app and navigate to the stock or asset you want to trade options on. Tap on the Options tab and select the call option you want to buy. Choose the strike price and expiration date that fit your strategy. Then select the number of contracts you want to buy. Next, sell a call option with the same expiration date but a higher strike price. The premium you receive from selling the call will reduce the overall cost of the trade, thus creating a debit spread. When buying a call debit spread, consider the trade details, including the net cost, the break-even point, and the potential profit or loss. The break-even point is the stock price at which the trade becomes profitable, and it is calculated by adding the net cost to the lower strike price. Best practices include setting a budget, managing risk, and monitoring the trade. Start with a small position size to limit potential losses and adjust as you gain experience. Keep an eye on the trade and be prepared to close it if the stock price moves against you. By following these steps and understanding the key concepts, you can effectively buy a call debit spread on Robinhood. Remember to always prioritize risk management and education when trading options, and never invest more than you can afford to lose.